Now we have this inflation going on still, and the Federal Reserve is saying, okay, well, we're going to now get aggressive with tightening. Now we're going to start selling assets. That withdraws money out of the economy. Now they're saying we're raising interest rates fast. That withdraws money out of the economy. Now we're seeing surpluses in given months and small deficits quarterly and yearly from the federal government. That withdraws money out of the economy. Now we're seeing the reverse repo facility continue to suck money in. That's pulling money out of the economy. Now we're seeing banks like JP Morgan say, we are shutting spending down. We are closing up the gates. We are prepping for a hurricane, literally said there's a hurricane on the horizon. And that withdraws money out of the economy.
Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I'm here with Joseph Brown from Heresy Financial. I watched Joseph about a month ago at Market Disruptors Live. He was one of the keynote speakers, and in his presentation, I was just blown away with the content. Since then, I was actually surprised, Joseph. I didn't even know who you were beforehand. And then when I found you online, actually, I saw you listed as one of the speakers, and I went and found your YouTube channel, and pleasantly surprised. Like, as I started going through your stuff, I became more excited about seeing you speak at the event than a lot of the other people that I was going there to speak. Because as I watched your content, I was like, man, I like to see the world through the same lens this guy sees it through, right? And so it's pretty exciting. And so today, I'd love to talk about just kind of like a current state of the union almost, right? Like talking about inflation and the Fed policy and the real estate, and like there's all this uncertainty and all this just craziness going on. And I think this unpredictable nature, nobody knows what's happening. Nobody knows what the Fed's going to do with increasing rates or decreasing rates. I mean, they're fighting unemployment and they're fighting inflation, which is like pretty hard to do at the same time, right? And so like, all this stuff. So I'd be curious, just kind of start off if you could, because you do a really amazing job kind of breaking this stuff down. Can you kind of start by talking about your opinion on kind of like just the overall state of what you're seeing from the Fed perspective? Because I think that's what drives everything at this point in time.
Mm-hmm. Yeah, absolutely. Well, first of all, thank you for having me on. And like we were talking about, off air, this is, we're in a time right now where it's easy to get sucked into anything that's, sensational. And so there are a lot of big names out there that have they hammer on the same drum always. No matter what is happening, it's always this is good or this is bad, and nothing could ever change the opinion on that. And so in reality, things are usually different than that. So we have to take a look at things, and it's almost impossible to do, but you have to take a step back as much as you can and look at things from both angles and see, okay, what is the most likely outcome here, totally, given all of the data, because things actually do change. And totally. A couple of years ago, if you would have asked me what is the most likely scenario moving forward, I would have said extremely high inflation. We just went through a huge round of money printing. If you ask me today, what's the most likely scenario over the next couple of months, I'd say we are potentially facing a sharp deflationary cliff. This is something that a lot of people, I don't think, are people are starting to realize there's the possibility for that, simply because we've had 2 years of very easy monetary policy, 2.5 years, and accommodative monetary policy that everybody's used to, free money, and money just keeps on coming in, and prices are going to keep on going up. And things have drastically changed over the last couple of months. And I think it's, things are changing too late. We have a bunch of forces coming together all at once. So I'll basically give an overview of why I think that. Yeah. So we've had this inflation for the last year or so, pretty bad inflation, pretty high inflation. And the Federal Reserve kept on beating the drum saying, hey, it's transitory. It's going to go away on its own, right? And then it didn't. And so they said, okay, well, we're going to fight it soon then, because it's not going away. So we're going to have to fight it. And they've always been like really slow, like, hey, we're going to fight it soon. And then they're like, okay, we're going to raise interest rates, and then we're going to start raising interest rates more. And then starting this month now, finally, they are selling assets, $95 billion a month off of their balance sheet. In the meantime, though, that's taken a long time to get there. The money supply growth has fallen off of a cliff. Last year, in November, it it had already dropped off the cliff. And so we saw the money supply, it was growing at a fairly steady rate. And then obviously the money supply spiked when they started printing a bunch of money and spending a bunch of money. And then that growth of the money supply dropped back down to where it was before. So the growth of the money supply right now is about the same pace as it was before 2020, maybe even lower. Okay. And the thing about monetary policy is it takes time for it to hit the economy. The Federal Reserve knows this as well. They've talked about this back in like 2017 when, or at the end of 2018, I think, when Powell when they reversed course and started QE again, or not QE, when they stopped QT, stopped raising rates to save the markets at the end of 2018. They said, look, it takes time for monetary policy to work its way throughout the economy, at least a year. And so the inflation that we've been experiencing isn't the result of the spending that the government has been doing this year. There has been no spending. That's why the deficit has been collapsing. And last month we had a giant surplus, actually. And so government spending has been collapsing. The growth rate of the money supply has been collapsing, but that takes time to hit the economy. Okay. And so we've had this inflation that's the result of past monetary and fiscal policy. Now we have this inflation going on still, and the Federal Reserve is saying, okay, well, we're going to now get aggressive with tightening. Now we're going to start selling assets. That withdraws money out of the economy. Now they're saying we're raising interest rates fast. That withdraws money out of the economy. Now we're seeing surpluses in given months and small deficits quarterly and yearly from the federal government. That withdraws money out of the economy. Now we're seeing the reverse repo facility continue to suck money in. That's pulling money out of the economy. Now we're seeing banks like JP Morgan say we are shutting spending down. We are closing up the gates. We are prepping for a hurricane, literally said there's a hurricane on the horizon. And that withdraws money out of the economy. So from all of these angles right now, we are seeing massive deflationary forces right at the time when we're about to start to get the deflationary forces hitting the economy from the money supply growth dropping off of a cliff starting last year. And so it looks like we are seeing an overcorrection from policymakers towards the deflationary side, where we could be facing a massive cliff here where things just start to drop like crazy. Unemployment, massive crash, bankruptcy, defaults, all of that very quickly all at once.
Isn't that just what happens though, dude? Like all the time, like people go, the market's going to correct. It never just corrects. Doesn't it always overcorrect almost in situations like this when it's been artificially kind of pumped up and manipulated and inflated? Like it doesn't ever just correct back to where it belongs. It always kind of goes too far.
Yes. Well, okay. So there's the difference between a market correction and policymakers trying to cause something to happen in the economy. Sure. If we took them out of the equation and we said, okay, we don't have any top-down control over the economy. All you have is basic free market principles. And I'm not even going to go sound money. I'm just going to say the same banking system that we have right now, fractional reserve banking, just no bailout, implicit bailout for the banks and the financial system. Sure. If you have that, you'd still have the boom bust the boom bust cycle, which is really a debt cycle, because as the money supply expands from credit, from the money supply expanding from credit, loaning money into existence, that money works its way through, bids up prices, and that overextends the growth. People spend too much money, then things tip over the other way when things start to get paid off, and that pushes everything into a bust. And so long term, you've got this growth curve, but it's not flat. It's like this, where things are volatile, basically. And so you get a boom bust cycle as a result of fractional reserve banking. And so that's the one thing. And you're going to have the recessions, the corrections, they're going to overcorrect from that average. Yeah. The other thing that we're experiencing though right now is the top-down control, where every time you start to experience that pain, they try and come in and put a floor under the pain and stop the collapse from happening. And so instead of getting the boom bust cycle, which is not supposed to happen, that's not the best scenario, but it's better than having the boom and then every time the bust happens, put a floor underneath it, because you can't eliminate risk, you can only transfer it. And every time they do that, it's like swallowing a bomb, like one of those superhero movies. If they have the ability to swallow energy, eventually it gets released on somebody, in the form of a weapon. And so that's the exact same thing that's going on right now. You've got all this risk that's getting swallowed by the Federal Reserve. It's getting swallowed, but that all it does is it transfers it to the entire system. And you get to the point where these central planners, then they have to choose between continuing on the current path, hyperinflating the currency, and you get a collapse of the currency and everything resets and just starts over and there's massive economic pain, or try and stop that and go this way, which is deflationary, but then you get a massive deflationary death spiral where you get the defaults. So you look at this and you think, okay, well, we're between a rock and a hard place with we can't go one way or the other. The reality is what you have in both situations is a deleveraging, because we lever it up. A deleveraging is inevitable, whether it's inflationary or deflationary. Our society, people, institutions have spent more purchasing power than they had. We've borrowed purchasing power from the future, brought it into the present. That's what leverage is. That's what debt is. It's happened. It's spent already. There's no way around it. It can look like prices going up in the form of an inflationary deleveraging, or it can look like prices going down in the form of a deflationary deleveraging. But either way, it's a deleveraging where there's unemployment, pain, suffering, not enough resources, not enough capital. And you have to go through that there's no other way. You spent the money already.
Totally. So one of the things I've been kind of talking about a little bit is the fact that it's June 1st or is it June 2nd right now? Regardless, it's the beginning of June, as we're filming this, and we're coming into the beginning of June where they're going to be the Fed meeting minutes that are going to come out, and they're going to talk about what they're going to do with the Fed funds rate. Are they going to increase it 50 basis points, 75, or are they going to retract and retrace or whatever, and maybe not do as much? What is the CPI numbers going to look like, as they come out? Is it on the 10th or the 11th? And those are two kind of big days, because what I've seen over the past month, when they increased rates and the market came down from say 35 to where it, like whatever it is, 31, 32 right now, and it kind of hovers, and it went lower and it came back a little bit, and it seems to have kind of leveled out based on the increases that we had last month and where inflation was, and kind of everybody's market confidence and consumer sentiment has kind of settled in. What do you think is going to happen over the next 10, 11, 12 days with all this?
Yeah, that's probably one of those areas that I have a little bit of a different opinion on than most people as well. I think the Federal Reserve is going to continue to tighten. They're going to continue on this path. They're not going to care that markets are falling. They're not going to care that 401ks are getting crushed. They're not going to care about the pain, the suffering, because they've explicitly said, hey, look, job openings are higher than the amount of people that are looking for work.
Okay.
That's the other side of their coin right now. They say we have two mandates from Congress. One of them is full employment. One of them is stable prices. We don't have stable prices right now, and we have full employment. And they look at those as opposite sides, different goals that you can pursue, one or the other. And no, we don't have a massive labor force participation rate, but if people could get a job if they wanted to because of job openings and they're choosing not to, then they have to say, well, what can we do? We're going to call that full employment. On the other hand, we don't have stable prices, so we're going to attack those prices until we get those job openings back down to a level where we say we're not at full employment anymore, which means the only thing right now, given their metrics, the only thing that will cause them to stop tightening is massive waves of layoffs, which means that we're going to get the layoffs because they have to happen for them to show up in the data, for them to use that to stop the tightening. They don't care about your 401k, your stocks, your crypto, anything like that. The only thing they care about is their dual mandates, stable prices, which they look at as slight inflation, small inflation, and full employment. And so I think they're going to continue down this path far too long. Not in reality, because I think deflation over the long term is good. We need the recession. We need the cure.
Okay,
but
cool.
They're going to cause such a sharp, painful collapse that they're gonna, in the end, they're gonna go back the other way. And I think that will be the problem, the response to this pain that they're gonna cause. But yes, I think we are in for, over the next year, a lot more pain than anybody is expecting right now. Everybody's thinking, okay, you can't taper a Ponzi. Well, it's not a Ponzi if you can print your money. You're not relying on money coming in from somebody else. It's not a Ponzi scheme. They can print their own money, so they can taper all they want. Scheme. Exactly. Yes, they can taper as much as they want. And the only other thing that they care about, which a lot of people say, is, okay, but if they keep on doing this, rates go up so high that the government defaults on its debt because it can't afford the higher interest rates.
Yeah.
And theoretically, that's true, but it takes a long time for that because it's not in their current debt. Their current debt is locked in. And so it's only on the debt that the government has to roll over. So it takes time for that debt to roll over to the higher interest debt. And if push comes to shove and the government's getting close to defaulting because it can't afford its debt service costs, all the Fed has to do is resume buying treasuries again. So balance sheet starts to go back up. And all the debt that the Fed owns is interest free for the federal government because they sweep all the profits that they make on their assets back to the treasury. And so the Fed just has to start buying treasuries again, and they can continue raising interest rates to whatever they want. They can continue to let people go bankrupt. They can continue to let unemployment go through the roof. They can continue to let asset prices fall, and they can still stop the federal government from going bankrupt or from defaulting on its debt by just buying treasuries again.
So you're more in the Harry Dent camp than short term, at least, in the sense that you think they're going to that deflation is the biggest risk, right? Maybe for different reasons than Harry Dent believes it's going to happen, but which I guess isn't irrelevant. But it's you think they're going to fight inflation and kind of have more austerity and more focus on making sure that price stability and inflation is under control versus worrying about the job market and worrying about employment and all that stuff.
I think so. And part of the reason for this is because how they make their decisions. They are so slow to change unless there's a crisis happening. Right. Very slow. And so if they're just looking at the incoming jobs data, which I think peaked in April, I think we're only going to get worse jobs numbers every single month. Or not April. April was a fall, but so that would be March. And so job openings fell. There's still more job openings, but it takes so much time. If you look at private statistics and indicators of layoffs, for instance, massive surge in layoffs in May. But the Fed doesn't see that data. They look at the official data that takes a long time to come in. And so total system wide, you still have job openings. So that needs to get all the way down to zero openings. And then you have to have people getting laid off and unemployment start to go back up. And then you have to have that impact prices, because one of the things that they've been saying is, hey, look, we've got this inflation because of the wage price spiral. The only way to stop the wage price spiral is to stop wages from going up, which means you have to have unemployment go up. And so they're looking for that in order to stop inflation. And I think by the time those numbers are coming back, we're going to have some sort of a big crisis, some sort of too big to fail, hedge fund blowing up, bank financial institution blowing up, further, wars, something like that.
So I was talking to this guy. Have you ever heard of a guy named Barry Dyke? He wrote a book called The Pirates of Manhattan. It's a phenomenal book. You should go read it sometime. But it's he was talking to me in an interview I did with him, and he was talking about how banks like Goldman Sachs, the investment bankers like that, they're leveraged 200-1 in some situation. Like it's like leverage for a company like that I couldn't even imagine, right? And so I haven't confirmed this, but I know this guy. He's like one of the best researchers I've ever met as far as this goes. So I have no reason to not believe him, right? So if you look at that, and it doesn't take much of a crisis, right, to like cause a problem, much of a deleveraging to cause a huge financial crisis for them, right? And so when I'm looking at this, I mean, when the first quarter we had contraction technically, right? Like it was like negative growth, and 2 quarters in a row is a recession, right? If that happens, I'm a believer right now that we're kind of in a recession right now. Nobody knows it yet, right? Like, I don't know how you feel about that, but
yeah, I agree.
I feel like once that's confirmed, consumer sentiment, just because the psychology of people, when it's confirmed that we're in a recession, you're seeing it already that companies are ahead of this. They're clamming up, they're bunkering up their assets and everything, that people are going to follow suit. And that's going to be something that drives us, through a pretty steep cliff.
Yeah, definitely. And so about the financial institutions, you're right. I mean, the banks in the US their balance sheets are a lot better, especially than they used to be back, 10 years ago, 12 years ago. However, banks, especially in the Eurozone, are still highly leveraged. Their balance sheets are are insane. And the reason that they're able to get away with that is because they engage in, just very simply explained, they engage in arbitrage trades where they sell one thing and then they use the money from that sale to buy another thing. And the thing that they sold and the thing that they bought are supposedly similar enough where they move up and down in price together. And so an example of this is like a stock with multiple share classes like Google. They've got A shares and C shares. One of them has voting rights, the other one doesn't. So for the most part, they're going to move up and down together, but there are slight differences. And so sometimes this stock will move up a little bit more than this one, and sometimes this one will move up a little bit more than this one. Yep. And so if you short the one that's a little bit higher and you buy the one that's a little bit lower, then when they converge, you close out the trade, and when they diverge, you open up the trade again. And so, but for the most part, your losses and your gains from each will be offset by each other. All you're doing is trading the difference between the two. The problem is they don't do it just with like stocks like Google. They do it with currencies and bonds, and they do it in a way where their mathematical models predict that these should move up and down together, but that doesn't always happen in reality. And all the major blowups for the last couple of decades have been as a result of these kind of trades, relative value trades. And so that's what these trades are engaged in right now. And when you have unexpected things happen, like energy crises and currency failures and emerging markets failures and wars, invasion, exactly, sanctions, defaults on debt from countries, not because they can't pay them, but because due to the sanctions, they're not permitted to pay them. When you have things like this happen, suddenly you have a lot of risk bleed over into those balance sheets, and a 2% move on these balance sheets is more than the entire market cap of their companies, of these of the shares of these banks. And so absolutely something like that happens all at once. And you have you have massive contagion, and then you have the central banks have to step back in and either buy those assets or do something to bail the system out.
All right. No, that's awesome. So let's shift now, because I don't want to run out of time and talk about some of this stuff, and to something a little more positive. And I'm being sarcastic when I say that. Food supply. I watched a video of you talking about there being potential food supply crisis coming down, and I know nothing about this. So I just wanted to, and I spend no time on the channel talking about it. Can you touch on what your thoughts are on what's going on in that space and why everybody should think about it?
Yes. Yeah, absolutely. So there are a number of reasons that we are facing a global food shortage that is more likely to get worse than get better in the short term. Okay. One reason for this is because of the way that supply chains work. So this is one of the smaller reasons, but restaurant food is different than grocery store food. They're different products. They have different supply chains. They have different farms. And so at the beginning of 2020, you had all these farms that were saying, look, we're dumping all of this food because we can't sell it because there's the lockdowns. Nobody's going to work. This is not being transported to where it needs to go. So it's all getting thrown away. And because of that, you had this cycle start where they're like, hey, next year, we're not going to be able to produce as much. So that's one piece of this, where you have, these are long-term things that take a while to unfold, but that started there from the lockdowns, smaller food production. And then you have heightened demand on, basically like grocery store food, because there's less people going out to eat. There's more restaurants that have been shut down and more restaurants that have gone out of business and things. And so there's more demand for this type of food that puts a strain on that, pushing prices up. The next thing you have going on is global supply chain stuff, where you've got, because of concerns, because of some shortages, because of other things, you've got countries that'll say, okay, we're no longer exporting this because we can't get what we need from other countries. So we need to lock down and at least keep what we have. Some of that is from the war right now. We're seeing countries all over the world right now say, we're no longer exporting our wheat. We're no longer exporting our oil. We're no longer exporting, these things that we have a little bit of, because we can't even get them from the other countries. So we're definitely not going to let our companies sell them to anybody else. And so you have that going on, which disrupts the supply chains, which makes it harder for other countries to get what they need. Then the next thing that you have, and this is probably the biggest piece right now, is the fertilizer shortage. Over the last couple of, basically the last decade, you've seen a lot of countries move towards green and clean energy. And basically what that meant was that they shut down clean nuclear energy and started up unstable wind and solar. And when it's unstable, they have to rely on dirtier energy like natural gas production.
Yep.
And that's especially true over the last year. Germany has relied on more and more energy from Russia than what it used to. And especially now with the war and the sanctions, it's getting even harder. So this natural gas shortage now is being diverted for energy use. And now that means natural gas can't be used to make nitrogen fertilizer. Nitrogen fertilizer is one of the most common forms of fertilizer, and even companies and farms in America right now are getting squeezed and saying we can't get enough fertilizer, or if we can get it, we can't afford it because the prices have gone up so much. And the lower amount of fertilizer means, yes, those farms can still produce some food, but not as much as they could before. And that impacts, that's compounding down the road. And so from all of these angles, we're experiencing these things that are saying, hey, we might be entering into a time period of more food scarcity than most people alive have had for a very long time.
Wow, that's crazy. So as you're talking about all that, I can't help but think, as you're talking about the fertilizer issue, I can't help but think, because you're talking about Russia and Germany, about the gas price issue and the oil. Have you looked into what's going on with that? Do you have an opinion on why gas prices are going so crazy right now and supply chain issues for that, or where do you stand with all that?
For gas prices, not too much. Early on, it had to do with the oil price shooting up so quickly, and then the gas stations. They're mostly, these gas stations are they're a lot more. It's a lot more of a decentralized industry than people would think. It's a lot of mom and pop stuff, and so you had initially an overcorrection in gas prices because oil moved and there were some losses. And gas stations, they don't make their money from gas prices at all. They make their money from you going into the store and buying candy and chips and hot dogs and coffee and donuts. And so the gas is basically just not a loss leader, but it's basically sell it at cost to get people in. Same with like movie tickets. They don't make money on the tickets. They make money on the food. And so initially that was it. However, oil prices, when they dropped after that initial spike, people were thinking, oh, that means gas prices should go back down, and they didn't. But now oil prices are back up again. And so it looks like the volatility has kind of bled over, and companies are saying, okay, well, we need to keep prices up so that we protect ourselves from losses. Even if oil for one day comes back down, it looks like that might not result in lower gas prices for the time being. And especially when you look at the supply and demand issues for oil right now, especially with the sanctions, the long-term cycle here with producing more oil, all the producers that have shut down over the last couple of years because of the lockdowns and things like that, it looks like we're in for a long period of time where energy prices go higher and higher and higher.
And if that happens, I mean, the ripple effect on what that does to consumer prices is pretty significant.
Yeah, I mean, energy is everything. Energy is growth. And so when you plot the consumption of energy against GDP growth, the correlation is virtually 100%. It's not quite that high, but throughout history, the more energy humanity consumes, the wealthier humanity is. And every time we stumble upon a new form of energy production that is more dense and a higher energy output, we have some sort of a revolution. And so that was, biomass, burning wood. That was a huge jump forward in terms of technology and wealth, because we get more nutrients out of our food. Right. And then same thing when we found coal. We didn't have to burn down the forests anymore when we found coal. That's a good thing. The places that are burning down their forests, we need to get them some fossil fuels so that they stop burning down the forests. I mean, that's the solution there. And it's not the cleanest, but it's a lot cleaner than burning down your forests, right? And so you always have to compare with, the real alternatives, not imagine some utopian idea pie in the sky. And then same thing with nuclear. If it looks like the tide is changing and people are starting to realize and wake up and realize how energy dense and how clean nuclear is. But these things happen. And every time we get a much larger source of energy, we build it on top of what we have, and we have a large and quick progressive, growth in technology and wealth globally.
Yeah, no, I agree. And you started off, this conversation talking about that you think we're more in a deflationary potential environment coming up. I think while gas prices going up and energy prices going up are going to show up as inflation in the economy, right? I think it's also a deflationary pressure, right? Because if energy goes up and people have to pay more for heat and gas and food and everything because of inflation, they have less money to go out and spend in the economy, and that's going to cause stress, right? I mean, that's the way I look at it.
Yeah, I mean, absolutely. Outside of intervention, the cure for high prices is high prices. But the people who are in charge, they can never just sit back and let something happen. Like there was it was called the Great Depression. We would call it now the Forgotten Depression. There's a book on it by Jim Grant, 1920, 1921. They called it the Great Depression at the time. And it was because of an artificial expansion of the money supply, because the Federal Reserve had just started a couple years earlier in 1913. So we had this depression. There was a lot of pain. The government balanced their budget. The Federal Reserve raised rates, and they went back to normal. And the recession, the depression, solved itself within 18 months. There's a lot of pain, but it fixed itself. They didn't learn the lesson from that, though. And Hoover at the time said, if I'm ever in power, when something like this happens, I will do everything in my power to spend money and intervene and get things back on track so there's not so much pain. He got his chance. He was president in 1929, started spending a bunch of money and intervening. The Federal Reserve did not raise rates. The government did not balance the budget. FDR actually campaigned on a non-interventionist, laissez-faire campaign and said, whatever Hoover is doing is bad. We need to step out and not try and fix the markets. And then when he got into office, he did just double down on everything Hoover was already doing. So we've got the history completely backwards there. But yes, if we just could step back and say, hey, we baked into the cake a lot of bad ingredients. Yeah. So we have some pain and suffering. There was a lot of debt. There was a lot of spending. There are a lot of bad businesses that shouldn't exist, that own a lot of assets that they should have known, that are incompetent. They're not financially responsible. People who are spending, not saving, going into debt, taking on too much risk. There's a lot of risk and debt and malinvestment built up in the system. If we could say, let's let the chips fall and
flush it out.
Exactly. Just let it happen. It will be painful. And that's what nobody wants to say. It will be very painful. There will be unemployment. There will be jobs lost. There will be bankruptcies, but we'll be better on the other side.
And we'll have a better foundation to rebuild from, right? I mean, isn't that what happened? I mean, maybe not as bad as the Great Depression, but when Paul Volcker jacked rates up in 1979, 1980, right? Like that's what, anytime we have that kind of pain and that kind of, I guess, behavior where people have to kind of take a step backwards, it allows us to kind of catapult forward, doesn't it? I mean, well,
yes, because the truth of the matter, like we talked about in the beginning, is that debt is leverage, and leverage is borrowing purchasing power from the future, bringing it into the present. That means it's been spent already. There's no way around that. On the flip side, savings is what enables all production, and you cannot have consumption without first having production. And so if you do not have savings, you do not have an economy. And to the extent that you allow debt to run away, you eliminate more and more and more of the savings, not only from the present, but also from the future. So if you let the collapse happen, then the incentives realign and people say, I'm not going to do that anymore. I'm going to save. And when people save, they build a base of capital that enables production in the future, which ultimately enables consumption. Because when you look at the one neighbor who spends recklessly his entire life, never saves, he goes bankrupt at 40. You look at the next door neighbor who never spent, never had a fancy car, but put money in his 401k and saved and never took out debt. He's going to retire rich at 40, whereas the other one is going to be just starting over at 40. And it's the same thing with an economy.
Yep, totally. So how do you think all this impacts real estate right now?
That's a good question. This is
the $1 million question, right?
Exactly. And this is one of those things, I get a lot of disagreement on this because it sounds like it's contrary to what I've been saying like this whole time. But ultimately things come down to a supply and demand issue. And we had a decade of lost supply. We had a decade where basically zero houses were being built, and we had the same exact population growth as we've always had. And so we are in a situation right now where we don't have as many places to live as there are people who want a place to live. That's the reality. And so that's one of the main drivers of house prices going up. Now, it's not the only driver, but it is a big driver. And that's one of the reasons why there are more hedge funds and financial institutions and companies and buying real estate today than there ever have been. And so they weren't buying up entire, plots of land and building houses in order to just sell them a year later when prices go down.
Yeah.
They're off the market forever. They're keeping them forever. They're going to rent them out forever. They're never going to go back into the hands and ownership of individual people ever. If that one company, that hedge fund goes out of business or wants to get rid of their real estate, they're going to sell all of their real estate, their whole portfolio, to another company that will then rent it out forever. And so we have this massive supply and demand mismatch. And so do I think that prices are going to go down in the near future? Probably. Probably. We have higher interest rates and higher prices. People can't afford the prices right now, and anybody who can is probably already bought. So I think we'll probably have a little bit of a dip in house price averages nationwide, maybe 10%. But by the time things get bad in the real estate market, things will have already gotten to crisis level somewhere else, because real estate moves a lot slower. And the reality is, the policymakers just can't help themselves. They will do something when the crisis gets bad enough, and that will propel housing back up. We're going to see a 40-year mortgage. We're going to see down payment assistance. We're going to see mortgage rates at 2%. We're going to see all these things come into place to say, hey, all the people, all you poor people, all you, we feel bad for you. So we're going to let you get into the dream of home ownership. That's going to bring in a bunch of new demand, and everything's going to go through the roof.
Wow. Yeah. No, so I couldn't agree more on all that. So that's awesome. So talk to me about crypto, like Bitcoin. I know that's a big thing. I know you talk a lot about it. It's kind of, the movement has been kind of correlated with the NASDAQ until the last couple of days from what I've seen, right? Like it's kind of detached a little bit, but that's a small sample. But what, you talk to somebody like Harry Dent and he says it's going to go down to like $7,000 and then bounce to the moon kind of deal. And then there are other people think that, we're probably close to the bottom right now. Where do you stand with all that?
Yeah, that's a great question. So we've got a short-term answer and a long-term answer. Short-term answer, I wouldn't be surprised if Bitcoin hits 20,000 or 10,000 in the short term. Okay. Technically speaking, that's more likely. We're experiencing from, when you just look at from like a trading perspective, a technical perspective, it looks like we're about to drop, and those would be the next two levels. 20,000 will probably experience some support, but there's not a ton of support there. There's a lot more at the $12,000 range. And so in my opinion, that's probably the lowest Bitcoin would go, is 12,000. Long term, I'm very bullish on Bitcoin. If it does hit 12,000, I mean, I'm going to be buying so much more Bitcoin if it hits 12,000. Yeah,
totally.
Yeah, absolutely. It's at that price, the risk to reward ratio is so unbelievably skewed. It's such an asymmetric bet because nothing fundamentally has changed. So long term, from everything that I see from central banks and governments doing to money, I think it's going to be driving more and more adoption of Bitcoin. That being said, what will cause Bitcoin to go to the moon, to $1 million, let's say, is a collapse in the faith in government-controlled money. So to the extent that there are governments around the world that say and prove that they will be competent with their money, it's possible that many people around the world say, I'd rather choose that than Bitcoin. Because that's all it comes down to, is, are the people going to want Bitcoin, or are the people going to want government money? Now, I would guess, just based off of history and the current environment, that governments are more likely than not to abuse the money, which means people are more likely than not to adopt Bitcoin instead. However, if there are governments that start competing with each other and saying, hey, we are going to have sound money, and it's going to be our own money, but we're not going to expand the money supply. We're going to have these set rules. We're going to make it very hard, whatever it is. People trust that, and it's strong, and it starts attracting capital. That's also a very likely scenario. So in my opinion, Bitcoin is still a very good asymmetric bet. I'm not saying that it's inevitable. I'm not saying that to go all in. I'm not saying that it's guaranteed. I think it's a good asymmetric bet, knowing what we know about history and governments. And if it does work out, it will pay off handsomely. And if it doesn't work out, that's why you don't go all in.
Well, I think for people in the US, they miss that point, right? Like we're so skewed in our way of thinking about like trust in government and all this stuff. We lose sight of, like, I got a buddy who's from Venezuela, right? Like, and he's like, dude, I escaped that crap. Like, and I got here. People here don't understand the real risks that we're facing. Like, he lived through it, right? And so, and it doesn't take more than 2, 3, 4, 5 governments around the world, like Venezuela, to shift and go all in with Bitcoin. for Bitcoin to go crazy, you know, because the market cap on that would just go through the roof. Right. And so, it doesn't take world adoption. It takes a couple pockets here and there that are doing, you know, significant moves with it.
Yeah, so there's a video that I'm sure everybody in the world has seen where it's from like 14, 15 years ago. It was one of the first videos that went viral on YouTube. It's a like one guy just dancing by himself.
Yes, that's awesome.
On the hill, right?
Totally.
And so then, you know, he's dancing by himself, and after a couple minutes, one other guy goes over and dances with him. And then within just a short amount of time, a couple other people join. And then within like a minute, every single person, hundreds, thousands of people are all dancing. And so it's not the first guy that causes the movement, it's the first follower. And so when I talk about mass adoption, by the time you get mass adoption, the price will have already moved. And so it does take some early adopters that are meaningful, some early movers, a couple big institutions, a couple countries, something like that, that pushes the price up to get everybody to notice. Maybe they are attracted for the capital appreciation reasons or whatever, but then you learn about how the money works, and then it's a snowball effect from there.
That's awesome. Well, dude, this is all awesome information. I appreciate your time coming on. Is there anything else that I haven't touched on that, you know, you're talking about that like people just aren't seeing, you know?
I think the only thing that we didn't touch on is gold.
Good point.
And I honestly, this is something, you know, everybody either loves Bitcoin or loves gold, and they don't get along with each other, and either think everything's going to the moon or everything's going to crash. You can't see that both might happen, but gold is one of those things that I'm still very bullish on. No matter what it's done short term, the small volatility relative to everything else. Number one, things have been crashing. Gold has been moving sideways. So you've gained in purchasing power if you held gold versus other assets over the last 6 months. That's a fact. So that's number one. Number two, it's still maintained its purchasing power for thousands of years. Given the price of an ounce today and what you can buy with that money today, for thousands of years, it's maintained or grown in purchasing power. So for savings, I still really like that. There's no EMP, global outage, global technology reset that can stop that. You know, it's still going to be a shiny rock that will exist until the heat death of the universe, basically. And so there's some value there. So for savings, I still really like that. And for a lot of reasons, it's been pricing in some coming deflation because of tightening. But once we start to get signs that that's stopping, that's turning around, man, gold anticipates inflation and it rides up way ahead of it. That's why we got the spike in 2020 before the inflation ever happened. And so it always anticipates that stuff. And so right now it hasn't anticipated the future inflation that we'll get when the tightening stops and they resume QE. And so I'm a big fan of gold and gold miners right now.
And how about silver? Do you do anything with silver as well? Or do you have an opinion on that? Because I mean, it's kind of similar, right? Like it's.
Yeah. I like silver. It's more of a high risk, high reward version of gold. I think that it has the potential to move up a lot more than gold does, but it's not as much of a savings vehicle as gold is. It doesn't have the value that it has is not as pure monetary value as gold is. It's more of an industrial metal today. And that's been a trend that has been going that way for about a couple hundred years. It's been losing more of its value, has shifted from being a monetary metal to an industrial metal. And you can make the same case about gold, but it hasn't happened to the same extent. And so I do like silver, just not as much of a pure savings play as gold.
That's awesome. Cool. Well, all right, guys. So here's the deal. If you want to follow Joseph and his YouTube channel, it's called Heresy Financial. I would go down in the description below. I'm going to put a link so you can go there, follow him, subscribe to him. You're also on Twitter, right? Like you do a lot of stuff on Twitter. What's your handle on Twitter?
It's at Heresy Financial on Twitter as well.
Just very, very simple, very clean, at Heresy Financial. I'll put a link for both of those down in the description below just to make it easy for people. And man, I just want to say thanks for being here. This is a lot of fun. I love these conversations. If I could just have these conversations all day long, that's what I do. I have so much fun with it, but appreciate your time, and hopefully maybe in a couple of months I can get you back on the channel and do it again.
Sure thing. Well, thank you so much for having me. It was a great time.
Awesome. Thanks, man. Guys, go down. If you haven't already, like I said, subscribe to him. If you haven't subscribed here, Click the bell. That way you get notified every time we launch a new video, and have a great one. We'll see you on the next video. Take care.